Hi, and welcome to Chapter 4, Risk and Return. In this chapter, we're going to be talking about the importance of calculating risk, understanding risk, and return. So let's start out with return. The whole reason we invest is to earn a return. And this is going to be some sort of profit we make from an investment. And it's the reward for investing. It's the exciting part of investing. So there are different components of return. And return is important because without it, no one would want to invest. And it's also a good measure of how well you're investing. So when we look at levels of return, we want to compare our return to similar stocks, similar portfolios to really gauge to see if we're making the right decisions. And return can be measured over time. And typically a year is the most common. Historical returns can look at returns for, say, different portfolios, stocks, and mutual funds over a historical period. Generally 10, 5, 1 year are most common. Now, the time value of money in returns are important because the returns can be diminished by inflation. And returns for a stock can greatly be improved through compounding. So time value of money is some important mathematical concepts to understand the long-term effects of returns and compounding. Now let's talk about the different components of return. The first component is income. So this is cash we're going to receive from the investment. Now bonds pay an interest rate, so you're going to get a return in dividends, but stocks also pay dividends. Not all stocks, but many stocks will pay a dividend, typically less than bonds, but it depends greatly on the type of stock. For example, stocks that are in the category income stocks typically pay higher dividends. Now, the second component is going to be capital gains. And this is the component that you make in the change in the overall price of the asset from purchase to sale. So if you buy a stock at $10 per share, you sell a stock at $20 per share, you have a $10 capital gain. And for a separate example, if you buy a stock at $20 per share and you sell the stock at $50 per share, you have a $30 capital gain. So it's just the difference between the selling price minus the purchase price. If you add the return of income and capital gains together, you get the total return on the investment. And this can be looked at a specific time. So here's an example of a profile of two different investments. So let's look at Target department stores and Discover credit cards. Now, we could see that they're both starting at relatively a similar price point, $72 and change. Over the time period for each quarter, you receive a dividend. So you receive 60 cents per quarter for Target and 30 cents for Discover. The total income for the year is $2.44 for Target and $1.30 in dividends for Discover. And then we have our ending price of the stock. So what we can see here is we have the income minus the capital gain. So this capital gain here, $7.50, is calculated by 72 minus 65. And here would be 72 minus 76. So we have a loss here. Total return, the loss is only $5 because of the income. Here, if we take the income, add it to the capital gain, the return is $5.49. Okay. So let's talk a little bit about why return is important. So return is important because we want to see how well the investment is doing in our portfolio and how much wealth it's building. So we get an idea of whether or not over the time period, if it's a growing or shrinking investment. So we want to look over performance over time. And this can help better our understanding of the future expectations. So if a stock routinely is stock price is growing by 20% a year, we can assume that something like that's likely to reoccur, but it's not a guarantee. Now, when we talk about expected returns, this is a return that we think we're going to earn in the future of the investment. So really what's most important is the expected return, because you could have a stock with very poor historical performance, but something's changed and now the expected performance moving forward is going to be profitable. So you might have a company, at one point, companies like Netflix and Amazon had poor returns due to a startup cost and losing money. But at a certain point, when the value of the companies became clear, the future expectation returns greatly increased. So really what's important here is, even though you might have a stock that has some poor performance, if the expected returns in the future, due to growing sales, a dominant business model, an innovative business model, or disruptive business model is going to generate better returns in the future, this is going to help determine what investors are willing to pay for the stock. So you might see some stocks that have very little or low earnings or even losses that greatly appreciate in stock price because the growing expectations are that the stock's going to be a big winning stock in the future. And that's what can run up stock prices well ahead of the actual generation of profits. So expected return is a difficult thing. It's a prediction. There's generally no guarantees, but the better you are at predicting this, the better financial analysis you do to predict more successful predictions of expected return, the better investor you'll be. So here is some historical data from ExxonMobil. So we could look at the income for the year, the average of the income, the beginning of the year price, end of year price, the capital gain or loss, which is just subtracting the end of year from beginning of year, and then the total return, which would be the dividend plus the capital gain. And we can see some years you make money, some years you lose money, and the overall average is about 1.46 per year, or 2.5% yearly return on average. In some years you earn, a good deal, 15%, 20%, and some years you lose a big deal, 13%. So it's kind of volatile, and it's closely tied to the oil market. But if you're predicting a strong oil market for the next year, a growing economy, a higher demand of oil, then you would expect that the stock price and the dividend would probably come in stronger the next year. Okay, so let's talk about the level of return. So the return is going to depend greatly on the type of the investment, stocks or bonds. Bonds typically have a slower growth of return, most closely linked to either the income of the bond or the capital appreciation of the bond, which is not as volatile as stocks. Stocks can have a much higher level of return and consequently a much higher level of loss too, or what we call capital loss. Now for stocks, what's very important is the quality of the management. A company is only as good as the management team running the company. So stocks with better management typically will outperform stocks with weaker management, of course. But the big question is, how do you determine what's a strong management and what's a weak management? And the only real answer to that is the track record of the management, and maybe even maybe even if you have some insider access to what the management thinks. That's why the annual report is important, because it does have a message from management about the company. And third, whether the firm finances its operations with debt or equity. So if a firm, now it isn't that debt or equity is good or bad. Sometimes it's wise for a firm to take on debt to help grow the business quicker, faster than they could do with just equity. And sometimes too much debt would make the firm riskier. So there is an analysis that can be done looking at how the firm manages its debt for its growth opportunities and how it manages its equity. Equity being the portion of the company that is outright through the stockholders or the company itself. So a company, 100% of the assets of the company are going to be made up of debt plus equity. There are also external forces that have out of the company's control, such as the political environment. For example, in the cannabis companies, the political landscape, as it's changing towards more legalization of cannabis, that's going to be a more positive effect on stocks who grow and sell cannabis. Now, the business environment is important too. What is the environment for the particular business? Is it pro-business, the environment? Is business in an aspect of growth? And this is closely tied to economic environment. So the business environment is more about the specific industry and fundamentals around that specific industry, and the growth of more a particular industry versus the whole economy. So the economic environment is really looking at the total, all the business environments together make up an economic environment. And growing economies help stocks to grow faster, which helps stock prices to go up. So if you take you take a political environment where politics are passing laws to encourage the ownership of electric vehicles by offering tax subsidies. The business environment is a growth environment for electric vehicles, and a more supportive environment as far as secondary suppliers, public interest, and success in automotive companies that make electric vehicles. Then the economic environment is one such as where the economy is growing, people's incomes are growing, and they have more money to spend and buy electric vehicles. So these are three good, if they're moving in these three directions, that's good. Now, let's look at the direction of price changes. So this is talking mostly about inflation or deflation. So inflation is overall prices in the economy going up. Deflation is prices going down. Now, we haven't had outright deflationary period in close to 100 years. So deflationary periods are one where prices are going down. And it's a very destructive time frame or aspect. Think of a housing market where housing prices are going down. And then everybody's waiting to buy a house because they want to wait for the prices to go down lower, which forces the prices down even lower. So this deflationary spiral is something that the Federal Reserves across the world work hard to prevent. Now, and luckily it's a rare event and usually localized. Now, inflation is the norm. This is where prices go up. So generally speaking, inflation is going to occur every year, and investors are going to expect inflation. And it's not necessarily a bad thing unless inflation gets too aggressive, because rising prices are just a fact of business and a fact of time value of money. As long as they're in reasonable increments, they tend to do no harm. But spiking inflation can be very damaging, because as prices go up quickly, profits can be vaporized by companies if their prices go up quickly. And it can be difficult for companies to pass along these prices and higher prices of their final product. And the timing could be awkward, because generally your prices rise before you're able to increase the prices on your selling of your products. Now, as far as investment returns, they're going to be tied to inflation. And this is going to vary between the type of investment, because different investments some investments will actually benefit from inflation, like gold and silver, while most stocks will not benefit. So it's really about how do investors feel about the future of the changing inflation and how policymakers are reacting to the inflation. And a lot of times investors can get a little panicky because rising inflation typically would signal Federal Reserves to increase interest rates, which will slow the economy, which will lower stock prices generally. So this is all things that investors need to think about. However, the way I look at return has always been long term. Don't look at return in a yearly basis. You want to buy companies and keep companies that are going to gain momentum over the long term. There may be a bumpy road of stock price before you get to a more stable and higher price. But that's why dollar cost averaging can be beneficial, because you'll be buying more shares. If you invest the same amount of money in, say, a mutual fund or one stock every month, you'll be buying more shares when the price is lower, and you'll be buying less shares when the price is higher. So overall, your dollar cost averaging will be a protection against the ups and downs of stocks, as long as the overall fundamentals of the company have good prospects moving forward in time. Now let's switch over to historical returns. And these are going to be looking at returns over time by a type of investment. Now, of course, there's going to be differences in annual rates of returns realized on stocks compared to bonds, compared to treasury bills. And then, of course, each financial instrument has its own historical return history. But if we sort of look at, this is an interesting chart where we can look at, and if you can't read this, this is backed up in the textbook. We could look at, and this is historical returns for major asset classes between 1900 and 2017. So we have a 117-year history here, or 118-year history. So if we look at Australia, stocks have gone up on average 12%. Bonds have returned 6%. Short-term treasuries and government bills have returned 4%, and inflation is 3.8%. Now, so this is important because if you look at your return, you should subtract your average inflation to get your real return. And you can see that, there are a lot of countries here. If you look at Denmark here, number 4, 11% return on their stocks, 7% on bonds, 6% on bills, and a 3.9% inflation. So, and if you look down here to the United States, 11% return on stocks, so a higher return on stocks than most countries, except for, say, South Africa, Italy, Japan. So it fits somewhere in the top half. A lower return, or middle of the road return on bonds and bills, and a little bit lower inflation than most countries, with Italy having the highest inflation. So you can see here, if you have a 10% inflation and a 14% stock return, that's really only a 4% real return in stocks, where in the US, 11% minus 3% is an 8.5% return on stocks. So that's why inflation is important. And countries vary because different countries go through different economic cycles, although they tend to move in similar patterns. Having a mutual fund or stock portfolio that includes stocks from a varying amount of countries helps to diversify your returns and stabilize your returns. This is something we'll talk more about in later chapters as well. But just an interesting worldview over the past 118 years. Now, this is no means a predictor of what things are where and how things are going to happen in the future. So things can be vastly different in the future. So this 11.5% historic return on stocks for the U.S. or, Denmark is very similar. New Zealand is very similar. Norway, Sweden, identical. United Kingdom. Will that occur again over the next 100 years? We don't really know. But the past 100 years is a good indicator that similar returns should be had over the next 100 years. Let's hope that their returns are even better. And that could be possible if the economy becomes more productive, more efficient, if utilization of resources become more productive, produce a larger output with less input, and population growth, it continues. Stock prices should continue to go up. So what we would want, ideally, in the best world, is companies being able to offer their products at similar prices while increasing profit margins. And that's what a lot of companies have done over the span of 100 years. Now, let's talk about time value of money and returns. So the time value of money, really you have to look at, but we could think about it in two ways. We have the compounding effect of the time value of money, which is very important. But we also have the inflationary impact on returns. So using spreadsheets, we can easily, like Excel spreadsheet, we can easily calculate time value of money. Now, financial calculators, a lot of textbooks will have financial calculator instructions. However, in the business world, virtually no one uses these financial calculators. everybody is using desktop spreadsheets or some other software to calculate the effects of time value of money. And so this is something that in a separate presentation, I'll go over the basics of time value of money. But it's an important concept because compounding is what really generates most of our returns over time. Okay, so let's continue with this time value of money, and let's talk a little bit about how do we determine what's a satisfactory investment. And I touched upon some of this in the overall returns before. So we're looking for an investment where the present value of benefits discounted by an appropriate discount rate equals or exceeds the costs. So when we talk about present value, this is the value of the money today. And we want the present value of the benefits to equal or exceed the costs. So an investment that is satisfactory because it's providing a return equal to or better than the return you can earn on similar investments. So if we set a discount rate, this is basically, sometimes can be thought of as an inflation rate, or it can be thought of as a cost of capital. So basically, if we take an asset and we look at the benefits of the return versus the cost, we get the present value. So as long as this return is greater than zero, we're making more than our discount rate. If the present value benefits are less than the cost, then the investment's going to be unsatisfactory. So we're really just looking at, over time, do we have a negative return or a positive return? But present value has to be put into play because you can't just look at your total return. You have to really impact it by a discount rate. And most generally in investments, our discount rate is going to be tied to inflation. So let's look at this particular example. So we have an investment here, and it's going to produce income every year. So this is probably more like a bond. And we can look at the present value calculation if we take the income and we divide it by 1 plus a discount rate to the exponent of the year. So the present value calculation is 8% discount rate. So we're discounting each of the year's income by a present value factor. And this gives us our present value of that money. So we can see that if we take all of the money and we discount it, because the money we get in year 7 is going to be the return of the bond, which is probably a $1,000 bond, plus the income for that year. And we can see that that income plus the bond is discounted to $700. But since we've been earning interest, even though we're discounting the interest along the way, this is our total return, or the present value of our return. It's not total return. It's the present value of our return. So this just gives us, we should compare this to the initial investment. So if the initial investment was $1,000, then $175 is our realized return. So again, we're looking at, and this is 8% is a high discount rate. Okay. All right. And again, I'm going to have a separate presentation on time value money and discuss how they're calculated and look at calculations of certain returns of assets. Now, there are multiple measures that we can use to help us compare alternative investments. So if we want to compare returns from different investments, we have to incorporate that time value money concept to consider the difference of the timing of the investment income and capital gains. So to make investments, we'll have different scales of capital gains and different timing of return and income. We have to utilize time value money to help produce an accurate, comparable return percentage. So there are concepts we have to look at, like real return, risk-free return, and required returns, holding period returns, internal rate of return, and finding growth rates. So these are different things that we're going to be talking about in the next 14 or so slides. Okay, so let's talk about real, risk-free, and required returns. Now, the nominal rate of return. So nominal is just going to be the return that an investment is going to earn as expressed in current dollars. So it's not going to take into account any type of inflation into the return. So it's just the actual return. So we're not going to actually reflect the inflation on it. Now, the real rate of return would be the actual return minus the inflation. So think of these as percentages. So the nominal rate of return might be 10%. Inflation is running at 3%. So that would mean that your real return is only 7%. Because inflation, how this works is that $10 say 5 years from now, will buy the same amount of goods as $7 today. So they're equal. $7 today is equal to $10 in the future because of the diminishing effect of inflation on the spending power. So when we say real return, we want to say, okay, we're getting a 7%, and we're getting a 10% return. After a 3% inflation rate, our return is really only 7% on our money because inflation ate up 3% of its purchasing power. So I can't, buy the same amount as I did last year because of this inflation. So the real return is very important because this shows us if we're really getting ahead. So the idea is, say you had all your money's in a bank account earning 0% interest, which I would never have said, if you asked me 10 years ago if that was possible, I would never have said bank accounts would yield 0% interest. It just wouldn't compute. But today it's quite common. And some accounts can earn negative interest depending on the country and the market you're in. But let's stick with 0%. If inflation is running at 3%, the $1,000 you have in your account is only going to purchase 97% of what it would have purchased last year. So you're actually behind. So you want to get an investment that's going to return 3% or greater to maintain your capital. And ideally, you would want to exceed 3% to grow your capital. And that's why it's important to look at the real rate of return. Now, let's look at returns and risk. So let me just move this down a little bit so you can see the formula. So investors generally should be risk adverse, meaning that you don't like risk and you'll take on risk, but only when there's adequate compensation to do so. Meaning that if someone's going to offer you $1,000 to jump over a pit, to say the pit's 6 feet across, and if you fall into the pit, it's only a 3-foot drop. So you probably would say that's well worth it. But would you still jump over that pit if it was bottomless? So if you're risk adverse, you might say, okay, the $1,000 is nice, but I don't want to risk the chance of falling into the pit and dying or falling forever. So generally people are risk adverse where compensation has to be adequate to cover the risks of loss. Now the required return is going to be the rate of return that's going to compensate you for the investment's risk. So if we look at this equation, we have it broken down by the full name versus the letters that represent, or the shorthand of the equation. So the required rate of return of an investment, we'll say J is the investment, is going to be the real rate of return plus the expected inflation premium plus the risk premium. So if we take the actual real rate of return, add whatever the inflation is on top of it plus the risk, this would give us what we would need, or what we could say is our required rate of return on the investment. So again, it's just a concept to look at, covering all your bases between inflation and risk, and the actual real rate of return. So this is breaking our return down into these 3 buckets. And back here, we talked about what the real rate of return is. So in the real rate, we've already subtracted inflation. So we're adding it back plus risk to get us our required rate. So let's move forward. Now let's look at this another way. So risk and return. So we have the expected inflation premium, and this is going to be the rate of inflation over an investment's lifetime. We have the risk-free rate, which is going to be the rate of return that can be earned on a risk-free investment. So such as, say, a short-term treasury bond, we can be considered a risk-free investment, meaning that there is almost, the risks are so small that you won't recover your investment that we consider it risk-free. So we consider to say something, there are many investments that can be considered risk-free, but we're going to use a short-term U.S. Treasury bill because it's considered to have the lowest amount of risk historically. So the rate of return you earn on this treasury bill is considered risk-free. There's no risk of default, basically. Now, if we take our risk minus our free rate, this is going to equal the real rate of return plus the expected inflation premium. So, so again, if we look at the risk minus the free rate, it's going to be the rate of inflation plus the expected rate of return plus the expected inflation premium. Okay, and it's denoted by this formula here. And again, these are just concepts. And the basic thing we're trying to say here is there's three components to your return. You have your real return, your inflation, and your risk. So there's different ways of looking at that. So your required rate of return is going to be the risk minus the free rate plus the premium would be your required rate of return, because you wouldn't want, whatever the risk is minus the free rate of return plus the risk premium added back in is going to be the required rate of return. So you could really just say that's going to be the risk-free rate plus the required rate of return. Now, this risk premium is going to be the additional return that you're going to require to invest in a risky investment to compensate you. So it's above, when you take out your risk-free rate, what's left over is this risk premium. And the riskier the investment is, the higher this risk premium is going to be. So for some very safe companies with steady and stable sources of income and profits, the risk premium is going to be pretty low. But for other companies where you're taking a big risk, whether or not, say it's a drug company, their portfolio will perform, you're going to have a higher risk premium. Okay. Now, as far as measuring return, we could look at the holding period. So the holding period is going to be what is your return over the period that you actually hold the stock in your portfolio. That could be a week, a month, 5 years, 10 years. So we want to measure this return over the holding period. So to do this, we have to understand what is our realized return. And this is going to be the income that the investor receives over the holding period. And what is the paper return or the capital gains or losses that are achieved, but not you realize we still own, when we say paper returns, it means we still own the stock or bond. We haven't sold it yet, but the price has gone up on it, and we have what we call paper returns. So they're not actual returns until the investment's actually sold. But we still want to know what the holding period return is over that time period. So we could calculate this using this formula. So income during the period, so whatever the period is, a year, 5 years, plus the capital gains or loss for that same period divided by the beginning investment value. And we could abbreviate the equation using these characters. And the capital gain during the period is going to be the ending investment value minus the beginning investment value to get the CG, the capital gain. So again, this would show if we add our income to our gain divided by our beginning position of the investment, we're going to get the holding period return. And this would be the total return over a period. It's not an annualized return. It's just so if it's a 2-year calculation and you earn 20%, that's a 20% return from the beginning. So if you invested $1,000, it's going to be a $200 return over a 2-year time period. It's not the same. You can't say a 20% holding period return is equal to a 10% of a 2-year investment. A 20% holding period return for a 2-year investment is not the same thing as earning 10% each year. because that would employ a compounding effect. So if you earn 10% each year, your total holding period return would be higher, like 21, 22%. So the holding period return is really just a return over a period of time. And it's important when you're measuring things like mutual funds. What's the holding period return over 1 year, 5 year, 10 years? And that's different from what is the average return over 5 years and average return over 10 years. So this holding period return tends to be a bigger number because it's the total percentage return over a specific time period. So it's a relative comparison. And if you divide it by the total return, by the amount of the investment, we can get sort of this relative comparison. All right, so let's look at this chart here. Now, here's 4 investments: savings account, stock, bonds, and real estate. So cash received. So we're saying here that we're getting some money in our savings account, some dividends in our common stock, some dividends in our bond. Real estate, maybe we're living in it and it's generating no cash. Real estate can generate cash if you're renting that real estate. So the investment over a year's time. So here we're investing end of year. Our investment is 1,000, 22, 900, and 3,000. Beginning of year. So we started out, the savings account typically has no capital gains. So all we have is our income. So it's a 6% return. I would love to get a 6% return in my savings account. You know, I do remember a time where I did get 6% returns and it was pretty nice, except inflation was about 4 or 5%. So not so great when you compare inflation to it, but common stocks. So we have our income, but we also have a capital gain here. So end of year, beginning of year, we have a $200 capital gain. We have our add the $45 income. We have our total return, or a 12% return on our investment. For bonds, our end of year is $970. We started the year at $1,000, so we lost $30 on the capital gain, but made $140 or 11% return. And for real estate, we had a capital gain of $300 or 10% return. So this is kind of just looking at different investments and how to calculate that holding period return. And this is just a 1-year scale. You could do the same thing on a 5-year scale or a 10-year scale, but it's going to give us our total return over that holding period, not annualized. Now let's look at another calculation that utilizes the mathematics of time value of money. And here we're talking about measuring the internal rate of return. So the internal rate of return is a stream of income. So if we're looking at dividends from a stock or a bond, we can look at that stream of income and we can compare it to a discount rate, which is usually an inflation rate on the investment, to come up with what the present value of the investment is in today's current money. So what's nice about the internal rate of return, we're going to get, when we calculate net present value or internal rate of return, net present value generally calculates a dollar amount, where internal rate of return calculates a percentage. We get to see what, if the investment actually has, in today's dollar terms, a positive or negative return. So it's important, even though these income is going to be given to us over a certain period of time in the future, we want to discount all those future dollar amounts to today's value, utilizing inflation rate, or what we call a discount rate, to really compare it in today's terms, in dollar terms, what our return is actually. And this gives us a more realistic return. Okay, so I'm going to end the first part 1 here. Part 2 of this lecture will be coming up, and it will continue with the internal rate of return, including the calculation.